The stock market has been on a historic run, defying expectations and shrugging off every obstacle thrown its way. Inflation? No problem. Rising interest rates? Still climbing. A global pandemic? The market roared back stronger than ever. But here's the thing. Markets don't go up forever. And when you zoom out and look at the bigger picture, some troubling patterns are starting to emerge. Could 2025 be the year the bubble finally bursts? Let's break it down. Right now, we're seeing a combination of economic factors that have historically preceded market crashes. First, government debt is at an all-time high, and the cost of servicing that debt is rising fast due to increasing interest rates. Central banks around the world have spent the last few years tightening monetary policy, pulling back on the cheap money that fueled the last decade's bull market. At the same time, corporate profits are under pressure. Many companies are struggling with higher borrowing costs, shrinking consumer demand, and supply chain disruptions that haven't fully resolved. Meanwhile, stock prices remain near record highs, driven more by speculation and momentum than by solid fundamentals. And then there's the bond market, often a leading indicator of trouble ahead. Right now, we're seeing something called an inverted yield curve, where short-term bonds offer higher returns than long-term bonds. This is a classic recession warning signal, and every time it's happened in the past few decades, a major downturn has followed. Even the world's biggest investors are showing signs of caution. Hedge funds, institutional investors, and even some of the biggest names on Wall Street are quietly repositioning their portfolios, hedging against downside risk. If the people with the most information and the best resources are preparing for turbulence, shouldn't you be paying attention? But the real question is, what can you do about it? A market crash doesn't just wipe out speculative traders. It can erase years of hard-earned savings for regular investors. If 2025 brings a major correction, those who aren't prepared could see their retirement accounts cut in half, their portfolios devastated, and their financial future thrown into uncertainty. That's why now is the time to take action. Not when the headlines are screaming about a crash, not when markets are already plummeting, but right now, while you still have time to position yourself wisely. In the next part, we'll break down the specific steps you need to take to safeguard your money, minimize risk, and even find opportunities in a market downturn. Because while crashes can be painful, they can also be the biggest wealth-building opportunities, if you know what to do. If a crash is coming, sitting back and hoping for the best isn't a strategy. The key to protecting your money and even thriving during a downturn is to take action before the storm hits. The first step is assessing where your money is actually invested. During bull markets, it's easy to take on more risk than you realize. Over the past few years, speculative stocks, tech giants with sky-high valuations, and even cryptocurrencies have delivered incredible returns. But these are the same assets that get destroyed when the market turns. If a crash is coming, now is the time to reduce exposure to investments that are fueled more by hype than by solid fundamentals. Some of the best investors in the world follow a simple rule: defensive positioning before a downturn, aggressive investing after it. That means shifting your portfolio toward companies that have strong cash flows, low debt, and a track record of surviving economic downturns. These businesses might not shoot up in value overnight, but they are far more likely to weather a storm. At the same time, having liquidity is one of the biggest advantages you can have during a market crash. When stocks start plummeting and panic sets in, most people are scrambling to sell. But those who have cash on hand, they're the ones buying assets at a discount. That's why some of the best investors, Warren Buffett, Ray Dalio, and others, always maintain a cash reserve. They know that when fear takes over, opportunities appear. If all of your money is tied up in investments, you have no flexibility. If you have a solid cash position, you have options. That's why it's worth building up liquidity before a downturn, even if it means temporarily holding on to cash instead of chasing risky investments. But protecting your money isn't just about selling risky assets and holding cash. It's also about diversification. The worst-hit investors in every crash are the ones who are overly concentrated in a single sector or type of investment. That's why spreading your money across different asset classes, stocks, bonds, real estate, even alternative investments like commodities or gold, can help reduce risk. Historically, certain assets tend to perform better during economic downturns. When stocks crash, bonds often become a safe haven. When inflation spikes, gold and other commodities can hold their value. And while real estate markets can slow down, rental properties in strong locations often continue generating income. Having exposure to multiple asset classes means you aren't relying on a single part of the market to protect your wealth. But positioning your portfolio is only one piece of the puzzle. Because if 2025 does bring a major market crash, knowing how to react when it happens will be just as important as what you do beforehand. In the next part, we'll cover exactly how to navigate a downturn, how to identify opportunities when everyone else is panicking, and how to come out stronger on the other side. When the crash finally happens, most people will panic. The news will be filled with fear, social media will be flooded with doomsday predictions, and investors who thought they were in it for the long run will start selling at massive losses. But those who understand how markets work, they see something entirely different: opportunity. Every major stock market crash in history has followed the same pattern. Prices fall sharply, investors panic, and eventually the market recovers, often reaching new all-time highs. The problem is most people don't have the patience or the confidence to wait for that recovery. They sell at the bottom, locking in losses, while smart investors quietly buy assets at discount prices. That's why the first rule during a crash is don't make emotional decisions. When markets are in free fall, it feels like they'll never stop dropping. But reacting emotionally, panic selling, moving everything into cash, or abandoning your long-term strategy almost always leads to worse outcomes. The best investors have a plan in place before a crash happens, and they stick to it no matter how bad things look in the short term. Instead of panicking, it's time to look for opportunities. During market crashes, high-quality assets get dragged down with everything else. Blue-chip companies with strong financials, real estate in prime locations, and even entire sectors that are temporarily out of favor, all of these become available at a fraction of their true value. The investors who recognize this don't just survive crashes, they build life-changing wealth in the aftermath. One of the most effective strategies is dollar-cost averaging. Instead of trying to time the exact market bottom, something even professionals can't do, you continue investing at regular intervals, buying more shares when prices are low. This way, you lower your average cost over time and benefit from the inevitable market recovery. Another strategy is to focus on assets that tend to perform well during recessions. Defensive sectors like healthcare, utilities, and consumer staples often hold up better than high-growth tech stocks. Dividend-paying companies also become more attractive, as they provide a steady income stream even when stock prices are volatile. For those willing to take on more risk, crashes can present incredible opportunities in distressed assets. Real estate markets often see sharp drops in pricing, creating openings for investors who have cash on hand. Some of the best deals in history have been made by those who had the liquidity and the confidence to buy when others were selling in fear. But perhaps the biggest opportunity in a crash is the chance to build a stronger mindset. The investors who come out ahead are the ones who stay calm, stick to their strategies, and continue making smart financial decisions even when everyone else is panicking. Market crashes are painful, but they are also temporary. If you position yourself wisely before the downturn, stay disciplined during the chaos, and invest strategically while others are fearful, you'll not only protect your money, you'll set yourself up for massive long-term gains. Because at the end of the day, the biggest fortunes aren't made during bull markets. They're made by those who know how to navigate the downturns. So, here's what we covered. The warning signs of a potential 2025 market crash are already appearing. Rising interest rates, slowing corporate earnings, and an overheated stock market. To protect your money, the key is preparation, reducing exposure to high-risk assets, increasing cash reserves, and diversifying your portfolio before the downturn hits. When the crash happens, avoiding emotional decisions is crucial. Instead of panicking, smart investors look for opportunities, buying undervalued assets, using dollar-cost averaging, and focusing on strong companies and defensive sectors. The biggest fortunes aren't made during bull markets. They're built by those who know how to navigate downturns. If you found this valuable, make sure to like and subscribe for more investing insights. And let me know in the comments, how are you preparing for a potential market crash? See you in the next video.